Copying. It's one of the over-communicated but under-leveraged tools of the common investor. Everyone talks about methods of copying, but few people find realistic and authentic techniques that actually yield a net profit. If you want to follow the path of successful investors, it can be beneficial to imitate their investment strategies. Munish Pabrai, who has a net worth of more than $100 million, is often compared to the prominent American businessman Warren Buffett due to his investment expertise, earning him the nickname the Warren Buffett of India. While others were searching for new and original ideas, Pabrai took a different approach. He openly but carefully and thoroughly copied the investment techniques of famous investor Warren Buffett, resulting in a substantial wealth.
I could not come up with these ideas on my own. I came up with this idea from Warren and Charlie, and I copied it. So one of the most important models that you can adopt is the model of cloning. When you see someone doing something smart, just incorporate it.
He submitted the highest bid of $650,100 in a charity auction for the opportunity to have lunch with the billionaire Warren Buffett. Since then, Pabrai has developed friendships with both Buffett and his longtime business partner, Charlie Munger. Pabrai's father was an entrepreneur who faced repeated business failures. He recalled times when his family couldn't afford groceries for the next day, or even pay rent. During his early years in school, particularly in the 3rd grade, Pabrai struggled with low self-esteem and poor academic performance, considering himself below average. This continued until the 9th grade. In the 9th grade, Pabrai had the opportunity to attend a prestigious school with highly capable students. One day, the school conducted an IQ test in his class, and he achieved the highest score amongst his peers. Curious about his test scores versus his grades, he asked the test giver for an explanation. The test giver acknowledged his brilliance, but pointed out his lack of effort. This realization sparked a change in Pabrai. Over the next few months, his academic standing steadily improved. By the time he graduated from high school, he ranked 3rd in his class, and he secured the top position when he completed college. He grew up in India and traveled to the United States to pursue a degree in computer engineering in Clemson University in South Carolina. While attending college, he took an investment class, and he excelled in it. One of his professors even suggested that he switch his major to finance and pursue a career in investing. Pabrai believed that business was easier than engineering, so he found the class to be a breeze. However, the reason behind his ease in finance classes was not superior intelligence, but rather his upbringing. His father, a small entrepreneur, had familiarized him with business concepts. After graduating, he worked at Telebs from 1986 to 1991. Following his tenure there, he took a leap and established his own successful IT consulting company called Transtech Incorporated in 1991. With around $70,000 in credit card debt and $30,000 from his 401k account, he managed to bootstrap the company. By the time he sold it to Kurt Salmon Associates in 2000, the company had generated over $20 million in revenue, earning him $6 million. While operating Transtech, he stumbled upon Warren Buffett while reading Peter Lynch's book, One Up on Wall Street. Prior to that, he hadn't been aware of Buffett's existence. Upon discovering Buffett's remarkable investment returns of 31% annually over 44 years, Pabrai was astonished. He delved into several books on Buffett's methodology, meticulously studied Buffett's letters to Berkshire Hathaway shareholders spanning decades, and he began adopting Buffett's investment principles. This allowed him to become a successful investor himself. As Pabrai delved deeper into Buffett's approach, he uncovered a couple of key principles that form the basis of Buffett's stock-picking strategy. Principles Buffett had learned from Benjamin Graham. The first principle is recognizing the price of shares. In the short term, the stock market behaves like a voting machine, but in the long term, it functions like a weighing machine. If you observe the stock chart of any company over a short period, you'll notice many ups and downs, like hills and mountains, or valleys and throws. Stock prices can be unpredictable in the short term, and they don't always follow a straight path. However, if you zoom out and examine the price patterns over a slightly longer period, you'll gain a better understanding of the company's stock. The chart will reflect the company's actual performance. Intrinsic value. When considering buying stocks, it's important to purchase them at a price much lower than what you estimate their net worth to actually be. This creates a gap between the current price and the intrinsic value of the company, which is called the margin of safety, a term introduced by Graham. To put it simply, if the market price of a security is significantly below your estimation of its true value, that difference represents a margin of safety. By buying stocks with a margin of safety, investors can minimize the potential for losses and make investments with minimal risks of downside. The margin of safety can be tailored according to an investor's risk preferences, allowing them to make informed decisions about their investments. Understanding the margin of safety. Let's say a stock is currently priced at $200, but it could be valued at either $100 or $300 in the future. In this scenario, buying it at $200 would be an unnecessary risk. According to Buffett, it's wiser to purchase a stock below its true worth, let's say at $100. By doing so, potential losses can be significantly reduced compared to buying it at $200. The margin of safety serves as a safeguard, ensuring minimal losses. Buffett uses an example to explain this concept. When you build a bridge, you insist that it can carry 30,000 pounds, but you only drive 10,000 pound trucks across it. This same principle applies to investing. Extreme patience. During the years 1970 to 1972, when investors were filled with excitement and stock prices soared to their highest levels, Buffett hardly made any purchases. He believed that it's not about constantly making moves, but rather about being correct in your decisions. When it comes to waiting, he was willing to wait indefinitely. Then, in 1973, when the stock market experienced a crash, he seized the opportunity and obtained a majority stake in the Washington Post Company, which he held onto for a remarkable 40 years. Presently, Pabrai serves as the managing partner of the Pabrai Investment Funds, a collection of hedge funds that follow the investment principles of Buffett's partnerships. He established these funds in 1999, and they focus on investing in stocks with strong value potential. Interestingly, the funds do not charge a management fee unless they achieve a minimum 6% return in a given year. Once this threshold is reached, a 25% incentive fee is applied to the profits. In recent times, Pabrai has shifted his attention towards philanthropy and giving back rather than solely accumulating wealth. In 2007, he and his wife established the Dakshana Foundation. This foundation provides intensive coaching to exceptionally talented students from impoverished backgrounds, preparing them for the entrance exam of the prestigious Indian Institute of Technology. The ultimate objective is to uplift these students from poverty and provide them with more opportunities. Pabrai's journey has been remarkable, considering the hardships his family faced in the past when they couldn't even afford basic groceries. Now, let's delve deep into two key concepts that you can learn from Manish Pabrai. Copying successful individuals allows one to leverage the knowledge, experience, and expertise that they have already gained. Pabrai recognized Warren Buffett, widely regarded as one of the greatest investors of all time, had achieved exceptional results through his investment strategies. By carefully studying Buffett's approach, Pabrai harnessed this expertise, saving himself the time and effort required to reinvent the wheel. This principle can be applied to any field, enabling individuals to learn from the best and incorporate their proven methods into their own pursuits. Copying successful models provides a solid foundation for growth and development. Pabrai's decision to adopt Buffett's investment principles laid the groundwork for his success as an investor. Similarly, individuals in any field can benefit from studying and replicating the practices of established experts. By doing so, they can acquire a solid foundation of knowledge, skills, and techniques that have already been proven to be effective. This foundation provides a springboard for innovation, allowing individuals to build upon existing successes and push the boundaries of their chosen field.